Welcome to Bar Chart's series of educational webinars designed to enlighten you about a variety of trading ideas and concepts, inform you of the features and tools Bar Chart provides related to those concepts, and offer traders insight to make a more informed investment decision. Today's session, Mastering Support and Resistance Trading Strategies. Have you ever heard a talking head on TV or a market pundit say something like, I like this stock because it's found an area of support, or I'd be wary of this market unless it can break through this level or zone of resistance? So, what is support and resistance, and how can they make these foretelling claims? Well, support and resistance is really just simply a level or zone where price once traded and advanced away from. They represent the remnants of the battles between buyers and sellers, and when prices return to them, they act as a psychological barrier where buyers or sellers once held their ground and forced price away. Hello, everyone. My name is John Roll. I'm Barchart's head of trading education, and support and resistance levels become reliable, actionable zones where we can look for entries or exits, and they also can help us guide us in trend identification. However, support and resistance zones alone are imperfect levels, and we need other technical analysis, for instance, like Bollinger Bands and moving averages, that can help to enhance our zone's authenticity. And tools like floor trader pivots and swing highs and lows can offer actionable levels inside of our support and resistance zones. Combining all this together with the understanding of support and resistance can make even the novice trader into a seasoned professional. So stick around as I support your technical analysis knowledge and limit your resistance to leave today's session. Now, before we get to all that, please welcome our moderator and Bar Charts Project Director, Gene Baker. Hello, Gene.
Good afternoon, John. How are you?
I am just fine. And yourself?
I'm good, thank you. I'm here to support you in any questions that might come through that our audience wants to ask you today.
And
Get it?
I
Support and
appreciate that.
resistance.
I love
No,
that.
no resistance from my side today.
No
Just support.
resistance. I love that. I love that. All right. Well, I got a jam-packed session as I always do, but so let's get started. Okay, Gene?
Okay, sounds good. Thanks.
All right. Just remember that today's session is for educational purposes only, and decisions to buy, sell, or hold should be made on the advice of a qualified professional, and that's under no circumstances shall we be liable for any damages or losses you may incur based on information that you receive or material you receive through barchart.com and our services. Okay. So, what is support and resistance? Now, on our charts, it represents these battles between buyers and sellers. So, for instance, resistance is when price rises and then falls, and then let's say the further price reverses from the peak tells us the strength or conviction of our sellers, or it might tell us that there's a lack of conviction or that we had very few buyers. So if I'm looking, for instance, this is a chart of Apple, and each one of these red arrows here represents a peak resistance where sellers overwhelmed buyers. This is a chart of Chevron, and each one of the green boxes represents where buyers gained the upper hand and where they were able to push prices higher. So price theory states that these levels of support and resistance acts as psychological barriers. Now, in behavioral finance, they're called recency bias. That's as traders or investors remember the recent price action. Or sometimes you'll hear a term called anchoring, where they overweight past price information, or they look at levels where they have recently had purchase points or selling points and to influence their decision making process. Whoops. So another aspect of price theory is that zones can persist with time, but they can become less effective with the passage of time. And things like fundamentals, market cycles, and investor sentiment can influence some older zones. Another phenomena that happens with support and resistance is as price violates or breaks or travels through one of these zones, its function transitions with the current trend. In other words, old resistance becomes new support and vice versa. So let me go back to Apple. And again, there is that concept of here we see price fell and found a level of support, created a level of support, and then price came back to it once, twice, and then the third time broke through it. And you can see that it went from a level of support and now is a level of resistance. If we go back to the Chevron example, here we have our levels of support, these two green boxes, and we said that time can have an effect on uh, these levels. And if I go back in time, I think I have to go back a couple years. Yeah, there it is. So I've gone back 2 years. So zones can persist through time, but there are some things that could change them. But you can see that our two more recent levels of support look like, to me, are reacting to a former level of support that was created almost 2 plus years ago. Okay. So let's do this. Let's go to a market. Let me go back to my charts here. Let's go to a market, and then I want to kind of show you this idea of how to draw zones, or the methodology maybe about how to zone. So I just pick a common market. Here's Amazon. And so what we want to do is we want to start at current price. And we're going to look down into the left for support. And we're going to go up into the left to look for levels of resistance. Now, this exercise that I'm going to do can be performed in all time frames. But as far as technical analysis is concerned, the higher the time frame, the more effective or reliant we are on these zones. So I would say that probably the time frame we want to start with is the time frame your trend analysis is going to be. So here I'm just in the daily time frame. So drawing lines as we did this process is a little bit subjective, and there's really no right or wrong way. Our goal here is we want to try to capture as much price action that is relevant to the time frame that we're looking at. Now, for my technique, what I like to do is I'm going to draw two lines that are going to create both my resistance and my support. Now, I'm going to use the highest high of an area where I believe there is resistance. So if I go from current price and I look to the left and up, you can see that this looks like a level of resistance. Why is this a level of resistance? Because price went up and price went down. And there was a battle here between buyers and sellers. And that sellers overwhelmed the buyers and price has now fallen. So what I always like to do is I start with the highest high. And then from that point, what I might do is what I want to do is I want to try to collect as many endpoints. In other words, closing prices or highs or lows relative to the zone that I'm creating. So because I'm creating a supply or a resistance zone, then I'm going to look to find as many closes that I can connect and maybe former lows, which now could be resistance, and new highs. So, here's a lot of closes right in this zone. So maybe I could find a line, which we kind of call the line of best fit. So we want to try to connect as many as possible. So maybe if I drew a line here, I'd get one or two closes. Maybe I get one high. Maybe I try to do these closes right here, 1, 2, 3 close. I get a low, and also I get these two highs. So I think in terms of my technique, what I'm going to do is I like right about here. And that would represent my area of resistance. Notice now I've gotten a high, a low, and it looks like about 3 closes. And you think about this, why would I use this? Well, again, as price broke this low, that would be bearish, right? And also this low corresponds with a previous close where price moved higher from. So a close below these close and below this low probably represents a good level of resistance. So let's go from current price and look to the left for levels of support. So again, if I started here, I think you could make a very good case that this is a level of support. Why? Because price went down and now it's starting to go up. And so, yeah, I could definitely use this as a potential level of support right there. But I think if we looked a little bit farther left, we'll see that maybe this price action is really reacting to this greater level of support where price traded sideways but never really gave up. So what can we do from here? Well, from here, I want to pick my lowest low, and there would be that lowest low right there. Again, if I'm going to start looking at where I'm going to draw that entry or that barrier of my support level, again, I want to try to connect as many of my closes, former highs and lows as possible. And what I always kind of like to do in this scenario is I'm going to start with this close. And if I look at that and I go from there to cross the left, notice how many closes line up with this and former levels of low. And again, here's former levels of highs. Old resistance becomes new support. So I think you could find at multiple lines here, but I think the best line of fit, again, is probably going to be pretty close to the close of that previous candle. And again, notice that this is a low here, a lot of closes right here, another low, another close, another close, another close, and there are 2 previous highs from past price action. So this is how you kind of draw your support and resistance. Now, again, support and resistance is relevant to the time frame that you look at. If I go to, let's say, a lower time frame, could I find a level of resistance? Could I find a new higher or lower high? Yeah, I think I could. Could I find a new level of support? Well, in this case, it doesn't look like that. So maybe what I could do is find a level of resistance a little bit closer to current price. If I go the other way into, let's say, a higher time frame, well, then what I do see is that the zone that I created in my daily certainly looks like a good resistance zone, especially since it relates to previous price action. Again, a real important process is to look at multiple time frames. But in terms of levels of support, right, we might actually think about something a little bit lower down here, or maybe as far as back to here. So again, the higher the time frame, the more effective or reliant the zones become. So part of that process of creating our zones, we actually looked at something called swing highs and swing lows. Now, this is an important process in developing our our support and resistance levels. So a swing high or low is similar to a peak resistance or trough, and that they represent those prices where price stopped moving in one direction and started moving in the other direction. And this is the key. Where does price stop moving in one direction and start moving in the other direction? Now, what is really nice about, for instance, candlesticks is what's nice about candlesticks is that they kind of help us visualize that, right? Where green candles turn red or red candles turn green. That's a nice technique to help you with these swing highs and swing lows. But again, like our zones, swings appear in all time frames. And so when we think about swing highs and swing lows, again, we're going to be better served in our technical analysis as an investor or a trader if we identify these swings in our trend time frame. Again, the higher the time frame, the more relevant and reliable. But again, if I go to say a lower time frame, here I'm going to a 30-minute time frame, and I look at price action, there's our daily swing high, but could this be a swing high? Well, price fell and then, yeah, it didn't really reverse, but it did stop from going down. And then from there, it reversed again. So this could be a swing high in this time frame. As far as our swing lows, well, again, our swing low looks like it's right in line with the bottom of our support zone. But could this be a swing low? Yeah, where price what? Stopped going down and started going back up again. Again, drawing our zones or creating our support and resistance zones. I want you kind of to concentrate on those zones that have your swings anchored within them. Again, let me say that again. We're going to create zones where those those swing highs and swing lows are inside of them. And then again, as a generality, these are more effective and reliable. So let's talk about touches, or when price begins to return to these levels. So the first touch usually gets the greatest or the largest response, and each additional touch becomes more muted. In other words, maybe not as much of a reaction. And what you might also notice is that as you have more touches, you'll get deeper penetrations into your zone. So again, let's look at the example here with Apple. Here we had a area of resistance and price fell. We made that first level of support, and we got a nice big movement out of this level of support. Now, it rallied all the way up until it re-engaged that level of resistance. And then it came back into that level of support. Not only did it come back into that level of support, but it got a much deeper penetration. And then it reacted, it got out of the level of support, and you can see that the reaction was a lot more muted than it was the previous time. Again, probably maybe reacting to this level of resistance. So there's two schools of thought here, and one of them is that says that the more touches in a zone and that zone holds, the stronger the zone works. Now, this is really for equities. And so here's a great example of that. So this is the IWM, and we're looking at a 2-year chart. And so a lot of these lines here that I've drawn were created for my show on Fridays for our premier members. It's called Market on Close. If you're interested in that, at the end of our session, I'll show you how you can watch that for free. But you can see here is the green levels represent support and the pink levels represent resistance. And so we had multiple touches over this 2-year period inside of this range for the IWM. But again, notice that on the downside, though, each ensuing penetration into our zone got us a little bit deeper into that zone. Not so much on the resistance side, not until maybe we had 3 or 4 touches, and then you did see get a little bit higher penetration into that level of resistance. But for commodities and Forex, the school of thought is that for each touch, it weakens the zone. So my first or second touch might be okay, but that third, now I'm going to start discounting that zone. I'm going to start thinking about maybe planning on a failure of that zone. In other words, I might look for some breakout trades. So here is Forex. This is the US dollar Japanese yen pair. And here is a level of resistance. Now it says first touch here. Again, this could be our swing high, but let's look at this from a historical standpoint. And what we can see is that first touch is based on a level of resistance. Again, this was created back in 1990. Zones can persist through time. That was really our first level of resistance touch. And notice that first reaction, big reaction from that. But then we got a second touch of this previous resistance zone and a little bit of a muted reaction, and then a deeper penetration into our zone. Again, the zone still held, but we got deeper into it. And then I got a little bit of a reaction out of it. And then now what we see is that price has broken through this level of resistance. And now what will probably happen is that this level of resistance will now become a level of support. And this might have been an actionable opportunity to take some type of breakout trade. Okay, so now we have a bit of a better command of support and resistance. So let's talk about strategies or actionable entries and exits and some other technical analysis as enhancements to our zones. So the first piece of information that I rely on is something called floor trader pivots. So yeah, perhaps because I'm a former floor trader, I believe in their value and to help me select, let's say, more timely exits or entries on my day of action. Now, Can you use these floor trader pivots to day trade, or are they designed for day trading? Yeah, for sure they are. But this is what I'm saying to you. On the day you want to trade, be it a long-term investor or a short-term swing trader, as price enters or is near one of your actionable support or resistance zones, floor trader pivots can be very beneficial. Now, what they're going to do is they're going to give you levels of support and resistance for that particular day. But that day might be the day you've been waiting for 6 months as price comes to your level of support or resistance. So what we're doing here is we're using micro analysis inside of a macro time frame. So floor trader pivots are calculated using previous day's highs and lows. They can be used to calculate multiple levels of support and resistance. And because of their popularity, because a lot of people use them, price behavior at these predetermined levels can become like self-fulfilling prophecy. So if I go to any of our symbols, for instance, here I'm still in the Japanese yen and dollar pair. Under technical analysis, you'll see something that's called trader's cheat sheet. So let's go in there, and the first default you're going to get are the pivots. And what the pivots do here is they kind of tell you where the pivot is for today, where is the first resistance, second resistance, third resistance, again, first, second, and third layers of support. Now, if you're interested in about the trader's cheat sheet and how to really effectively view this, I have done a couple webinars, but here's a link to one of our webinars on how to use the trader's cheat sheet. Now, some of the things about the trader's cheat sheet that you need to understand is that these pivots are created based on yesterday's settlement prices. In other words, yesterday's range and yesterday's settlement. And they're updated after settlement. In other words, after settlement yesterday, then we will create the trader's cheat sheet that you can use for today. Yesterday's prices gives you those elements for today's price action. But if you're interested in terms of the calculations of support and resistance pivots, here is where we will show you that formula. Again, they are intended for current trading day sessions, but they are based on the previous day's session. But there's a lot of other information here. I'm not going to go into a lot of details here. Stochastics, Fibonacci's, moving averages, highs and lows. Well, for instance, here on the highs and lows in the Japanese yen, if we look at what is the last price and we see that we're above 2 layers of resistance, that might be an idea that we are getting into, maybe a momentum type trade. But in terms of weekly, monthly, and yearly highs, you notice they're all the same value, and that price now is above the second resistance, below the third resistance, but is now about to take out this multiple high. So again, this could be a very good level of resistance, or I might look for some kind of a momentum breakout trade. So let's change our contract to our Apple. And again, I can go into my menu and look for my trader's cheat sheet. And again, there's where we can find those pivots. Now, what's really nice about what bar chart does for you, on any of your interactive charts, you will find something that's called templates. Now, under the templates here, we have bar chart templates. These are default templates. And the one down here in the bottom is called the 13 EMA pivots. And if I click on that, that is going to give me is going to draw the pivots on my chart, which is really nice for a lot of technical analysis. And we're going to go through that process in a moment. But let me talk about this template. So first of all, the template gives you a default time frame of 5 days and 30 minutes. Now, I created this template based on equities. So if you're a forex trader, if you're a commodities trader, you might use a different time frame, and you can just add the study of pivots to a template of your own design. And again, you might have a different time frame that you want to use. But the reason why I did this, and this will make a lot more sense as we look at some of the other elements, is one of the first things that you're going to get is called a moving average, exponential moving average. And this one is a 13 period moving average. Now, 13 periods in a 5-day, 30-minute time chart, if we think about the equities market, there's 13 30-minute periods in one trading day for the stock market. So this moving average, this exponential moving average, is a nice moving average because it gives you an internal momentum trend, and it also can act as levels of support and resistance. So let me do this so we can kind of dissect this. I'm going to close my eye on this one. I'm going to take that off. And it also gives you an RSI, another momentum type indicator or oscillator. And again, momentums for RSI is based on a 14 period, again, closer to our 13 period. But we do have a 5 period moving average. So the green line represents kind of your raw, and the yellow represents that 5 period moving average. And again, you can use this as a moving kind of a momentum indicator. So I'm just going to turn that off. So that leaves us with our pivots. So the pivots here, now some folks might add pivots, but the template has already created this for you. But you can change the colors. And what I kind of do is I like to have my colors from light to dark, from inner to outer. And that's what I have here. So what we're going to do now is we're going to use pivots on our day of action. In other words, when price comes into our zone, I'm going to use my pivots to help me find more actionable levels, or based on my type of trading. Am I a conservative? Am I looking for lowering my risk, or do I want to find more of a confirmational idea? So let's do that together. So what I'm going to do here is I'm going to go back to my daily time frame, and for the moment I'm going to close my eye on my pivots. So let's talk about strategy here now. So I've decided that I have a level of support that I want to buy Apple for, say, and so there's 3 types of entries that I can use. So the first type is more of an aggressive type. And this is a type where I don't want to miss the opportunity, right? So I'm going to set my entry, my order, on the edge of the zone as price comes into my zone. Now, again, this could be an exit strategy as well. I'm already short and I want to take profit, and I want to take profit before I find the level of support. So either way, exit or entry, the same concept. So I'm going to be aggressive. I'm going to do this right on the edge of price action. Now, the risk here is that price could continue to fall if you're an entry. So you'd have a greater risk depending on where you're going to set your stop. Maybe it's on the other side of your support zone. But if you're a seller and an exit, then that's that lost opportunity. That price is going to continue to fall further. So the second thought behind entries into a zone is something called a zonal entry. And a zonal entry, here we're waiting for price to penetrate into our zone of action. Now, this will lower our risk on our entries because now we're deeper, or we're closer to that back end of where we think risk is. As far as exit, right, you're going to capture more profit, but again, there's that element of lost opportunity. And then the third type of entry is called a confirmation entry. And this is where we wait for price to enter our zone. Well, let's go back for a second here. I just remembered something. On my zonal entries, right? So the question might become, um, where do I buy in the zone, right? What level or how deep do I allow price to come in? And there's a lot of different techniques. You could look at the previous candles based on a closing price or the low of a wick or something to that effect. But I know a lot of traders do this. They'll come into their Fibonacci's here, and we'll get the retracement Fibonacci. And what they'll do is they'll just do a Fibonacci retracement of the zone. And then what they'll do is they'll put their entry order or their exit order based on one of those Fibonacci numbers. Now, there is a bit of a risk here, right? So let's say if you go too deep in your zone, you might risk not getting a fill, right? So this is a technique you can use. I just want you to understand that there is a bit of a risk if you go too deep into a zone. All right, so the third type is our conformational zones, entries and exits, and this is where we wait for price to enter our zone and then exit our zone. And so as price exits our zone, then we will do that actionable trade. We'll either buy if we want to get long, or we'll sell if we want to get out or take profit. So again, for my entry, your risk is about the same as that uh, first type of trade. For your exits, again, you might have multiple touches, so maybe you don't take all your profits. Maybe as long as your trend is in control, maybe you wait for a secondary or tertiary test into that zone. Okay, so then, okay, like I said here, so then price comes back into our zone. All right. So now let's use this idea of macro and micro. So I'm going to go into my pivots here in a second. And so let's say I've decided that today I'm going to buy Apple. Well, why am I going to buy Apple? Well, maybe it's because I've gotten deep into my zone. My market is held that extreme level of my zone. And what we do see now is that prices stop going down, right? Maybe pretending we can see a beginning of a new swing low. And yesterday, we got a close above that last down candle's high. So that could be one of my confirmational entries. And today certainly looks like the market is moving higher. So what can I do? Well, I'm going to come back into my pivots and I'm going to turn them back on. And let's go back to that lower time frame. So let's think about those types of entries, right? So I'm decided that today is the day I'm going to purchase Apple, and I'm going to be aggressive. I want not to miss out on that opportunity. So, because I've given myself permission to do that. So, what would I do? Well, the first thing I would look at would be I want to buy at our pivot, our main pivot. So, here you can see this green candle represents the close from yesterday, and this is the 30-minute opening. So that would have given us an opportunity. I don't want to miss that opportunity. I want to buy today. So I'm going to buy the first pivot, that price support pivot that price comes to, and that would have been that entry today. What's our second entry? Our second entry is our zonal entry. We're going to wait for price to go deeper into our range of potential price for today. So that would mean that I'm going to look for a deeper support, either this first support or this second support. Now, notice that the second support does line with our level of the back end of our support zone. So a cautionary here is, yeah, maybe that is a low risk trade if this does hold, but I'm getting very close of price falling out of the support zone. So maybe the better zonal entry would be this first level of support. And I'm going to show you something in a moment using other technical analysis why that might be the case. And so the third type of entry is that confirmation or confirmational entry. So what do we want to see? Well, we want to see price take out resistance. We want to see price continue to move in a favorable trend. So this again, this is where our exponential moving average gives us that permission. As long as price continues to move higher, or we could use this as a confirmational, actionable level. For instance, we could say, hey, we've now seen our moving average has crossed over our first level of resistance. So that might give me permission to buy, or that we're now crossed over the second level of resistance. That could give me permission to buy. So we could also start look at something called Bollinger Bands. And again, let me go back to my higher time frame. And again, I'm going to turn off my pivots just for the moment. And I'm going to add a study. And this study is based on a statistic called standard deviation. And what we're looking at is basically a probable range of price. Now, this is based on the defaults is based on a 20-day moving average and 2 standard deviations. So the technique that you want to use on this here is we want to come in and we're going to draw lines on our bands, our lower bands and our upper bands. Now, the upper band for today is outside of the realm of where I'm making that actionable decision. But you can see that, let me turn off my 13 here for a second, that here is our mean. So that's the only band that I really need to draw, because notice that our outer band is right on that lower level of our support zone. So let me just draw a line right here on our mean. So again, I'm going to come back and turn on my pivots. And again, let me go to that lower time frame. And notice what we see, that here is that Bollinger Band median or mean, and it is above our second resistance and below our third. So a more conservative trader on a confirmational basis would like to see price above the mean of the Bollinger Band and above our third resistance. Now notice the Bollinger Band here is still on, but we're looking at a 30-minute time frame. And again, that intraday analysis, and this is what I was saying to you before, that zonal entry would have been a nice zonal entry right on that first level of support, because it's also on that outer band of our intraday Bollinger Bands. So here we're using multiple time frame analysis on one specific technical analysis that is helping us with our selection of where we want to be. Again, if I was doing a zonal entry, I'm going to miss that opportunity. I've missed that opportunity today. The market didn't come to me. That's the risk of zonal type entries. All right, so let's go again. Let's go back, and I'm going to turn off Bollinger Bands for a moment. And again, I'm going to turn off my pivots. And there is another technique that you can kind of use in terms of our identifying our levels of support and resistance. And I'm going to come into my templates again, and under my bar chart templates, we have the 20, 50, 100, and 200 simple moving averages. Now we give you a comparative relative strength. This is where you're comparing the stock to the S&P. And again, if I'm buying, I really want to see my stock outperforming the S&P. Right now, what we're seeing, they're kind of both of them are kind of flat, but we don't need that for right at this moment. It's just another piece of information for you. And again, when I start looking at my levels of support and resistance, I really kind of like to find this confluence, right? I like this area as a really good level of resistance because why? Because it has the 100-day moving average and it has the 200-day moving average, and they're both down sloping. My 50-day moving average is down sloping right around where I have those two swing highs. And I can see my red line here is my 20-day moving average. Again, a down-sloping 20-day moving average. So I'm buying into a downtrend. So that is a contra-trend trade. But on a confirmational basis, what do I want to see? Well, I want to see price get above that 20-day moving average. Now, notice where that 20-day moving average is. I left those lines in before from our Bollinger Bands and also our zone. And so what the market is telling us here on this analysis is if you want to buy Apple, you probably want to wait until price gets above the 20-day moving average. Well, let's bring back in our pivots. And so this is where I might have to go back and add my pivots. And let's make this nice and big for you. And now this really makes more sense to us, doesn't it? Because as a confirmational trader, I want to recapture our 20-day moving average. I want to get above our third resistance. I want to get outside of my support zone. So what is the market telling us today for Apple? Well, it says that Apple could be a buying opportunity, but just not yet. When we're going to need to wait for either a confirmation or wait for a retracement deeper into our zone. Okay, so I wanted to go in a little bit more detail on some stuff, maybe going into another market to do this process, but I'm running out of time and I want to try to answer some of your folks' questions. Okay, so give me a moment here, Gene, so I can kind of get through some of these questions.
Yeah, while John reads through the questions that you've submitted, I just want to point out that a lot of the features that he's showing you on these charts today, like adding in the bar chart template with the pivot points, that's available actually for free users on our site. However, if you want to save a lot of the tools and everything, John's drawing a lot of rectangles on the chart and trend lines. It's easy to do so if you have a bar chart account. We offer 3 different levels of membership: free membership, a bar chart plus membership, which allows you to save up to 10 different chart templates with your own setups, and a bar chart premier membership, which gives you unlimited charting capabilities.
Yeah, I think that's a huge benefit, Gene, about the being a subscriber. All these presets, you don't have to redo it every time you come back into one of your charts. All right, so I have a question here: is are bars better than candlestick? Again, this is just a preference of a trader. The reason why I like candlesticks is because candlesticks tells the story of the individual candle of buyers and sellers, right? What is that story? What is happening? Who's winning those battles? And so when I'm doing a zonal construction, I can really kind of zoom in on where that change occurred. Now, this would be a great example, right? Here, price went down, sellers were in control, and then buyers came back, right? They pushed price back up. The next day, price gapped up. But look at this candle here with this long wick. Price fell all the way down into this candle, filled that gap, but the wick was able to get all the way down to here. So again, let me kind of just turn a lot of these things off in terms of getting us a little bit confused here. But let me just show you this. Let's say, pretend that this is that draw, that's that battle line where buyers stepped in and said, nope, no more. We're not going to go any lower than that. And, look how well that this level on the first and second touch was a good level to enter. Now, the third touch, we got a little bit deeper into our zone. Again, that deeper penetration as the zone maybe is weakening. So that is kind of a technique that why use candlesticks over, let's say, a um, a bar chart. But again, it's just up to the trader. When putting trend lines, is there a best chart type? I guess that would be the same uh, uh, scenario. Again, trend lines are subjective. Last couple weeks ago, we did a webinar on moving averages. I would watch those ones to get idea that moving averages are really kind of fluid trend lines. So watch that one again, and I use both candlesticks and bars for that. Wayne asked, have we done any kind of back testing on the trader's cheat sheet? So again, Wayne, that's up to you. But have I done back testing on traders' pivots? No, I haven't. But my back testing has been 40 years of experience. And again, this self-fulfilling prophecy that I find that they're very, very reliable on my days of actions. Okay. How do you think about placing stops when selecting entrance price into a zone? David asked that. Again, David, so you could have the number one type on the edge of the zone, or the zonal entry would probably be a limit order, and the confirmation order would probably be a stop order. But in this case, we probably wouldn't use a stop. We would use what is called a stop limit. Right? We don't want to like chase price out of the zone. We're going to pick a level based on where we believe that breakout occurs, or where price gets out of that zone. Now, normally what I'll do is I'll put a stop limit on a very specific value, and then I'll add what is called a buffer. Maybe, for instance, in a case like Apple, maybe I'll use a 10 or 15 cent stop buffer, so that makes sure that I at least get that fill. Here's a kind of a rule of thumb. Look at your ATR and use a 2% of your ATR, whatever your ATR is. Use 2% of that as your buffer. That's a kind of just a general rule for trading. So the question is, can pivot lines be good for 5-minute tradings? Again, pivots are designed for intraday trading. They're only good for one day. So if you're looking at a 5-minute chart, why not? Which is cool is you can use pivots at even higher time frames. So look at this. I'm going to go turn my pivots back on, and I'm going to go to a weekly chart. Now, again, I have that 13 period moving average, and do I still have it? No, I have this is not that template. But look, the pivots are still here. They're still on my chart. I'm looking at a weekly chart, right? Do these kind of pivots make sense to me? Yeah, they make a lot of sense to me because they run into a lot of my moving averages. They run into levels of support and resistance. But the thing is that they're only good for today, right? Brian asked about Heiken Ashi. Brian, we have a webinar on that. Watch that. Ann gave me a thumbs up. Thanks, Ann. I hope that you appreciate that. Okay, so we got about 5 minutes left here. Let's go back to our slides for a second. Let me give you some takeaways. All right, so oops. Support and resistance represents these battles between buyers and sellers. That's as simple as I can make it. That is the truth about price, right? However, they also represent these psychological levels as the market kind of remembers where these battles were, right? And then when price returns to those levels, then other traders or traders who got left behind or missed on an opportunity or want to get back in or want to get out, right? They wanted those these levels now become self-fulfilling prophecies. Now, swing highs and lows and our floor trader pivots offer us opportunities to identify not only trends, right, that intraday momentum for pivots, but also how we can refine our entries and exit levels on our days of action. Other supporting technical analysis can significantly enhance the strength and reliability of these levels. So again, Bollinger Bands, moving averages, RSIs, MACDs. There's a Heiken Ashi if that's what you're into. That is fine. It, just be consistent in your methodology. What I offered to you is how I use my methodology, and I think it's a very simple process. I look at my pivots, I look at my Bollinger Bands, and I look at my moving averages. And when I get this convergence of evidence, that is an area where I want to take that action that I'm looking to, or desirable action that I'm looking to do. Time and touches can deteriorate the effectiveness of support and resistance levels. Equities might take a little bit longer. Commodities and Forex, I do believe that every touch weakens a zone. And then again, as these zones are violated or as price breaks through them, then their function can change. And the old adage is old support becomes new resistance and vice versa. Okay, so as Gene said before, whoops, one of the nice features that we have, and I told you about my market and close show on Fridays, and that's for our premier member, is that we have a 30-day free trial. So you can try out all the stuff that we just went through on today's session, but also if you want to come in and check out market on close on Friday, that's what we do with our premier members. You can do that for a 1 month free trial period. Okay, Gene, I think I got everything in today. I'm surprised I actually did that. So
We're going
let
to
me,
talk about next. Yeah, let's
yeah,
talk
that's
about
what I
next
was
week.
getting to,
Okay.
Gene. Okay, thanks. Yeah, so next week, we're going to talk about another template that we have, and also on our investing page. It's called the TTM squeeze, and this is based on two technical analyses, which is Keltner bands and Bollinger bands. Again, another one of my favorite trading tools. And what we're going to discover is that it's based on volatility, but think about markets in terms of springs that are being coiled and then springs that are the energy is being released. So the TTM squeeze shows you when that is happening. And so I'm going to show you how to use the templates. I'm going to show you how to decipher what the squeeze is. And we'll look at some other technical analysis that'll help enhance potential squeeze signals or squeeze firings, so to speak. So come on and check that out. I think those of you like volatility type trading and are fans of, let's say, Bollinger Bands, this is another way to elevate your technical analysis. Okay. All right. Until next time, folks, best of health out there. Manage your risk and the good of all trading.